Welcome everybody, this is Ken Goldberg. We're here doing another close-in view of the Decision Support Engine, the DSE, and its components. Today's component for focus is the Standard Deviation Bands. I want to start off showing you this chart on your screen. It's the bell curve, as most of you have heard of, and to be specific, the area from the midpoint over to the right or to the left, but the area in the yellow section is one standard deviation. The blue area is two standard deviations. As we can see from this graphic, two standard deviations includes 95% of reality. Three standard deviations, or what's called the fat tail, these pink zones are called the fat tails. Three standard deviations includes 99.7% of reality. I'm going to back that out a little bit so that the numbers are more clear. And we're about to talk about how to use standard deviations in our analysis of different market movements. I'm going to put this chart away for now. And we're going to look at the main screen that we always look at. And specifically, I'm going to zoom in on this chart, which is the S&P 500, symbol SPX. Many of you know it, SPY, that's the ETF. And for the moment, we're going to disregard, I'm actually going to take it off. We're going to disregard everything on this chart except for these bands of standard deviations with which I've turned on their side. So above and below the price bars, you'll see this kind of golden olive looking band here. Then on the outside of those is an orange band. And on the outside of that is a red band. The olive band is two standard deviations. As we saw from that graphic a moment ago, 95% of reality is contained within this range, these two olive bands, 95% of reality. And as we look to the left, you'll see that most of these price bars, all the action is in between the olive band on the top and the olive band at the bottom. And we can zoom this out so we can see going back a whole long time. This goes all the way back to March of 2012. You can see this goes back to now the October 08 area, the crash into the March of 09 zone. So look at the black price bars, and you can see that for the most part, price trades within these two olive bands, two standard deviations, 95% of the time. Once in a while, as you can see right here, I'll highlight it this way, this yellow box, price broke down and went to and actually through the orange band, three standard deviations is 99.7% of reality or normality. And only during the 08, look far to the left, only during the 08 plunging portion of the decline, over here, the far left yellow box, did prices go down through the orange band and to and briefly below the red band. 4 standard deviations, 99.9% of reality. Excuse me. So what does that tell us? What that tells us is these standard deviation bands, both above and below the typical price pattern, are places where reality doesn't really exist. Yeah, it exists for a couple days above the gold or olive band. I'm going to just call it olive because most people tell me they see olive on their side of the screen. For the most part, Price does not go above the olive band, nor does price go below the olive band, except for in extreme panic situations like we have both in 2008 and in the big strong sell-off in 2011. And since 2011, price just hasn't even been close to that 2 standard deviation band on the bottom. We call that the lower 2 standard deviation band, or the lower 2 band. Price has risen continually up along this upper 2 standard deviation band, the upper 2 band, in what's called walking up the band. Walking up the band. But rarely does price go above the upper band as well. And hardly ever, and nowhere on this chart, can you see prices at the 3 standard deviation band. Only here, for a brief moment in time, did price approach but not touch, in May of 2013, the upper 3 band. It's just statistically extraordinary for price to get that extreme on the upside, especially in a stock index. We'll look in a minute to see what happens with individual stocks. So again, the olive band is 2 standard deviations, 95% of normality. The orange band, 3 standard deviations, 99.7% of normality. And the red band is 4 standard deviations, 99.9% of reality. In other words, if price does go below, far left side of the chart I'm showing you now, if price does go below that red band or above that red band, but for this case, below that red band, it's a bad bet at that time to bet in the direction that price was going. In other words, below the red band, below 4 standard deviations, is a bet that you're smart enough to trade in an environment that 99.9% of the time is unlivable. That is a horribly bad bet, and that is why people that sell at the bottom of sell-offs are often dramatically disappointed, to say the least. Similarly, people that buy at the top of big blow-offs, for instance, this box here in 2013, buying at the S&P level of 1680 was a bad idea. Almost immediately, the S&P fell to 1565, 115 points, nearly 10%. So it's just not a good idea. So what we do is we use these areas of just not a good idea to have the DSE go and filter out what actions, whether they're buy actions or sell actions, what actions are indicated from 300 years of historical data. So here we are, back zoomed in the S&P. I'm going to put it into the middle of the page. I'm going to shrink it down so we can see all of the 2, 3, and 4 standard deviation bands. And what does this tell us? Oh, by the way, these bands revolve around this blue line right here. This is the 200-day moving average. So anytime you see at least us here at DSE Trading talk about the 2, 3, and 4 standard deviation bands, they always revolve around this 200-day moving average. So what does it tell us? It tells us that on a DSE basis, there's no signal based upon the standard deviation bands. Why? Because price is absolutely dead center in the middle of the 2 standard deviation bands at the top and at the bottom. Why? Because price is right at and trying to hold the 200-day moving average. So based solely on standard deviation bands as a component of the DSE that we're looking at today, there is no signal at this moment, at this time. Back here in February, that was a sell signal, as it was in December of 2014, as it was in November of 2014. But right here again in the middle, no signal. Let's look at something that might have a signal happening. Amazon. Very interesting chart. What we're going to focus our eyes on, if we can, so I don't have to redraw everything. There's a lot of different yellow boxes and things like that. Those are different levels of analysis, which we'll get to in different modules on the DSE. But for now, we're going to look at the olive, the orange, and the red bands, 2, 3, and 4 standard deviation bands. We're not going to look at this blue band. And at the bottom, we can see the 2, 3, and 4 standard deviation bands. So what happened? Amazon was at the 2 standard deviation band and dramatically overbought. It announced earnings, and it exploded up through the 3 standard deviation band and attempted to get to the 4 standard deviation band. Upon that earning announcement, I'll move this blue line just for a moment. Upon that announcement, this tick right here is where Amazon opened that day. Now, if you're a member of DSEtrading.com and in the chat room, you heard us talk about this in real time. If you read us on thestreet.com or read us at WaveBoom, then you saw in real time when this opened up above the 3 and approaching the 4, we said price of Amazon up near 580 has hours to live here, maybe a couple days, definitely not a couple weeks. So a few hours to a few days. What happened? By the end of the day, that 580 opening was a 530 close. In other words, 50-point decline. Why? Because statistically, above this orange line, 99.7% of the time, price trades below it. So betting, the people that were buying, traders and investors buying Amazon above 540, no matter what the reason was, were making a bet. They didn't know it unless they used this level of analysis, but they were making a bet that they were smart enough to buy and sell Amazon in the future against 99.7% of normality. That's a statistically impossible bet to win for very long and very many times. Bad bet, horrible bet. So what happened? Up through the 3, testing the 4, immediate reversal, and then several days of decline, which burnt up a lot of this energy. And now the question is what's going to happen next? Well, price came all the way back to the upper 2 standard deviation bands, still overbought, but it's Amazon. So what's going to happen? We don't know. And for the purposes of this introductory and teaching video, we're not even going to speculate. That type of speculation and trade setup we do in our real-time DSE trading chat room. And you're welcome to continue on and join that and see us narrate and do trade setup there. What was my point? My point is that the statistical learning that we did a few minutes ago about percentages of normality are proven here. And it won't be long before they're proven again by price breaking down below the 2 standard deviation band and heading probably in the next year or two. So by middle of 2016 or late 2016, we're probably going to see Amazon trading much closer to 400 as it reapproaches the neutral zone around the 200-day moving average. 200-day moving average is where price is neither overbought nor oversold. So we call this the neutral zone. This is the zone that money can begin accumulating Amazon because there's not a whole lot of stress to the system. Up above the 2 standard deviation band, a lot of stress to the system. Above the 3, huge stress. Above the 4, it almost never happens. Can it happen? Sure. Does it happen? Rarely. Let's see if we can find some place there it did happen. The favorite stressor of financial systems. Look at this. This is Google. What happened to Google? Again, here are the same bands with notes: 2, 3, and 4 for the olive, 3 for the orange, 4 for the red. Standard deviation bands, both above and below. Google has an earnings announcement, blows it away. The day before, the day of the earnings announcement, Google's trading between the 2 and the 3. Statistically impossible to maintain for very long. Earnings come out. It explodes up through the 4. This would be the 5. This would be the 6. It probably reached the 7 standard deviation band, which is 99.9999 something percent of normality is contained within. So what happened? Well, we know that above the 3 is very hard to maintain, and certainly above the 4 is very, very hard to maintain. After a couple of hours to days, Google reverses from the 7 standard deviation band up here near 713, immediately comes back down, breaks through the 4, comes down to the 3, and loses 65, 70 points, about a 10% decline. Then what happens? Well, then there's less extreme. People have decided they're going to try it again, and they're trying to keep it now, as you can see in the past couple of days on this chart, above the 3 standard deviation band. But look, it doesn't have the explosive energy that it did here. So this movement above the 3 is what we call an echo move, with much less energy, much less enthusiasm, much less money. So that's why it's failed to get above the 4 this time. It's going to break down through the 3 and head down towards the 2. And then the next year to year and a half, we should see Google much below the 600 level, getting back to the neutral zone around the 200-day moving average. So that's an example of how we use standard deviation bands, what they are, and how the market responds when the extremes of these outer bands get tested. Thanks for joining us, and stay tuned and join us in the DSE trading room as soon as you can. Thank you.